Good morning, everyone. How's it going? It's Wednesday, November 15th, half an hour before the market opens. Yesterday, we talked about how I had high conviction that we are nearing levels where we needed to pull back from. So we'll see how well the market is supporting that theory this morning. And then we had the PPI that we wanted to pay attention to, but we said that there's probably going to be a muted reaction to it compared to the CPI. We've already kind of shot our ammunition on the CPI. So it'd be surprising if we got a huge reaction from that. And then also the retail sales. So let's go ahead and start taking a look and see what everything looks like. All right, futures. Futures are up. Futures are up about what third of a percent right here, about 0.5% on the NASDAQ, and a little over a third of a percent in the, or under a third percent of the Dow. So up. It's up, and it's not quite random. It's a little bit above random. So far, futures are not supporting my theory. Looks like futures are have a upward bias. So let's take a look at that. Let's see how the reports came out first. PPI, better than consensus, better than expected. So PPI is coming down month on month. We're at 1.3% versus 2% consensus. And then the ex-food and energy year on year, 2.4%, so down from 2.7%. So positive news on the inflation front. And then we also have retail sales. Retail sales is better than consensus. All right, so definitely way down from prior, but better than consensus. So this is not great news to be that far down, but we are above consensus. Overall, we call this neutral to just a little tad-ish bearish. So let's see how the market reacted to that. All right, so we can see right here, this 530 mark right here, huge volume. Initially, it was up, and then we came down. And ever since the 530 mark, we've been down, we've been underneath this VWAP line right here. We've been trending down. We had a little bounce right here and we're coming right back down. So that's really interesting. That's really interesting to note. So even though PPI was very positive for us and retail sales was mostly neutral, the initial reaction is what you would have expected. But after that, there's no follow through. It just actually, it was an excuse to come back down and relieve some of this bullishness that we had in the futures market. So that removes some of that bullishness in the bullish bias that we saw in the futures market. So we want to look at this a little bit more carefully. That's interesting to note. Let's take a look on the daily on the SPY. So we have overhead resistance immediately right here, right at this peak right here, where we hit the zone yesterday and we closed right at the bottom edge of the zone. But we have the higher edge of the zone still here, looming above us, and then we have this high above us right here also. So it's going to take a lot to push this market up above those two lines right there. Where we see yesterday, the reason why we had high conviction that we're going to have a pullback pretty soon is that we hit this plus 3 ATR. We gapped up again. This has been a huge run up. This has been over 10% run up from here with just barely a pause right here. So this market needs at the very least a consolidation and most likely a baby pullback. So we got to be cautious here. So I was very enthusiastic about a pullback, but we need to read exactly what that means. It doesn't mean that we're bearish. Okay. And if we go into bearish type of trades, like I showed you yesterday in the aftermarket, we have to realize that that is counter trend at this point. We have made a higher high right here. And as long as we make a higher low, then we have a change of trend to the upside. So if I make a bearish trade right now, that is counter trend, and we don't want to get stuck in a counter trend trade for too long. So if we go bearish, it's super quick. On an immediate pullback, we would be out. We would make that money, and maybe it pulls back even further than we thought it would pull back, but we wouldn't care at that point. We'd just be waiting for that bounce. So this is just quick trades you have to be very nimble if we're going to go to the bearish side and go against the trend. So we're really just looking to see a pullback, maybe to this breakout point, maybe to just filling the gap. So we're not talking about a huge amount of distance here. So you don't want to turn your entire portfolio bearish because of this. You just want quick little trades that to take advantage of a possible imminent, well, highly probable pullback. Okay. So let's see the economic. Let's take a look real fast at Fed Watch. So there's a lot of enthusiasm because of this inflation data that the Fed is going to continue to pause, and people are even anticipating that we will get rate cuts in 2024. So now we're almost at 100% conviction that there's going to be zero rate hikes. So you can see that just a week ago we were at 90%. A month ago we were at 70%. So we have gone to almost certainty that in December we are not going to we're not going to hike rates because of all this inflation data that has come out. And that is really what's driving the anticipation of no rate hikes is what's been driving this up, other than the technicals. And so if we actually get rate cuts in 2024, which I don't believe it'll be in the first quarter or maybe even the first half of 2024, but if the market is going to do this just on the anticipation of pauses, think of what's going to happen if the Fed actually cuts. That's going to be a major bullish driving factor in the US. So why would they cut? The reason why they would cut is if they believe that we over tightened, the economy starts to turn downwards or have a threat of recession. That's when the Fed was going to cut. And now it has some room to cut, as we have over 5% Fed rate now. So there is now room to cut and stimulate if that is necessary. But that's a little bit too far down the road. We're in pre-market session, so let's just look at the day ahead. So with all of this information that we have right now, I would be very cautious. Now, we don't want to get married to this idea that we're going to pull back, and then miss opportunities to the upside if that's what actually happens today. So we want to be balanced in our approach. We are still expecting that pullback. We don't know that for sure that it's going to be today. We don't know for sure that it will happen tomorrow or Friday, but we are very confident that it will most likely happen within these 3 days. It doesn't mean it has to happen in these 3 days. It could happen sometime next week as well. But we just want to be cautious. So we want to let that market indicate to us which way it's going to go. So we're going to draw our lines. So we've got this line right here. Let's make that purple. And so in the pre-market, we bounced off of that level twice. We've been somewhat consolidating around here. We have a consolidation around here. We do have this high up here. I'll just mark it, even though normally that wouldn't be too important. That was the 530 spike right here. So it is interesting to note where that turned around, but this level is going to be more important to me. We have yesterday's close, which had a lot of action around it in the post-market. We have the low into yesterday's close, which was pretty much the VWAP line. And these are levels, and I am going to pay attention to that VWAP today as well. I also want to say that we have the possible overhead resistance from yesterday, which we did react to. So we're going to keep that line. And we happen to be at that line right now. And then I want to see if we break up to the upside, I want to see this high and this high. So this high is at 452.08 and 457.80. So let's get 452.08. And then it was 450. 782. That's a little far away, but we'll mark it anyways because okay. So because we've had such strong movements over the past 2 weeks that I'm not going to rule out the possibility that we could approach it. But for the most part, this is the range that we're looking at. If we stay within these lines that we've drawn right here, that's just going to be consolidation, chopping sideways when from the perspective of the daily chart. If we break out of these ranges to the upside, we'll know that it is a strong move. And then if we break down to the downside, that's a strong move. And again, we're leaning towards sometime today, tomorrow, and Friday, most likely a downward break. But we are going to not trade based on that. We're going to allow the market to show that to us with high volume bars, large candlesticks, momentum, and to indicate that that's the direction that we're going to move. Everything else to us is just going to be choppy movement right here. So if we want to see some pre-market stuff, Target did announce its earnings today. It had strong beats, but on the comments, they weren't so upbeat. So it's interesting that we were way up, even though their forward projecting was not that great. So if I look at Target, it's set to open way up here near the MA 150 line. So that's a huge jump upwards. So I would be watching Target very carefully for break to the downside. So we can put some lines right here. And if it breaks upwards, I just leave it alone. I wouldn't bother chasing Target because it's gapped up so much, and if it started to move upwards, so for example, if the S&P started to move up and break out and Target moves to break out too, I would just leave it alone. I would just, if anything, I would do the S&P rather than Target. If it goes to the downside and the market goes to the downside, then I would definitely be doing Target to the downside because it has a lot of room to fall. And then TJX also announced, okay, they had positive earnings surprises as well. And we can see in the pre-market, they're way down here. So two major retailers, both beating, although Target did beat by a lot on the revenue, whereas TJ Maxx beat, but not nearly as much as Target did. But we have opposite reactions, right? So the TJX way down here, Target moving way up higher. Our anticipation that markets are going to pull back leads me to say, okay, the better opportunity is within Target to the downside. But if that never develops, I just won't do the trade. So, but if it does develop, that is a very high probability and high return type of trade right there. So I'm going to pay attention to Target and TJ Maxx. And what we notice is after the 530, I want to see what that trading action was. So 530 right here, S&P started to move downwards, even though we are still up versus the close. Here, at the 530, this didn't do much. It mostly just chopped sideways. So Target is still relatively strong to the market right now. And then TJ Maxx, we closed over here. Initially, it traded higher. So that's interesting to note. Before the earnings announcements, it traded higher, but then it started to move downwards. And at 530, no real reaction until a couple minutes ago, we're starting to break down again. So that's not necessarily a reaction to the news. This is just traders continuing to pull TJ Maxx downwards. So let's just get a couple lines on here on TJ Maxx as well. So those will be what I'm watching. I'll still watch Tesla. Tesla is strong to the market. 530 though, it started breaking down pretty hard. Okay, so we can watch Tesla as well. So let's position ourselves carefully. So that means that we're not going to put our entire portfolio in reverse and bet to the downside. We are going to cautiously move to the downside and be quick and nimble in our trades to the downside. We'll have a balanced approach. So the way I would do it is maybe 2 positions or 2 allocations short, 1 allocation long. That way I have a hedge in either direction. And of course, the ones that I would go long would be the strongest stocks, and the ones that I go short would be shorter stocks. So stocks that are strong to the market, this is the wrong ticker. So stocks that are strong to the market to the upside, and stocks that are weak to the market to the downside. So how would I know that? Well, if yesterday with this gap up and strong move upwards, there was a stock that also gapped up and a strong move upwards, but was even stronger than the S&P. So maybe instead of having this trade up and then pull back, we actually closed on the highs. That would be strong to the market. Weak to the market would be a red bar, or we're actually down on the day, or a red bar that would fill the gap, or maybe we never reacted. We just went sideways, or we went down from there. Those would all be weak to the market. So that's how I'd be playing right now. Just balanced approaches, hedged, and short the weakest, long the strongest, and with a bias towards the short side. Watch these levels. Oh, we didn't look at bonds. That's going to give us a clue. In the pre-market, you see bonds are down. So we had the gap up yesterday, but now we're going to have a bit of a gap down in bonds. So that's going to put pressure on stocks as well. So it's looking like more and more things are stacking against the upside movement of the S&P. So far, the S&P 500 has been able to overcome all the things that were stacked against it, but now we're putting more weight on it. And there's only so much after skyrocketing like this, there's only so much fuel left. At this point, we were light in volume before. We put capital to work yesterday. I made the comment that if I was still an institutional trader, I would be putting into the market what I was forced to put into the market via rules, and then wait and see what happened. This continues to trade stronger, so more institutional traders may put a little bit more capital work to the upside. But for the most part, there's not going to be a whole lot. This would cause a lot of nervousness in institutional traders as well. So we're going to be keeping our powder dry, or we're going to be hedged very carefully against a pullback. So they may be the opposite of what I said. I said 2 shorts and 1 long. They might flip it around, 2 longs and 1 short, just in case of this pullback. But everyone has to trade their own way and their own view of the market. So this idea that a lot of people have of, oh, you let the market dictate what you're going to do, instead of having a view. That's not how it works institutionally. You have a view, you have conviction in your view, you trade your conviction, but you hedge yourself in case that you're wrong. You always recognize the fact that you might be wrong, but you need to lead the market. You can't wait and react to the market. Reacting to the market is very much a retail trader's mindset. So we always want to be ahead of the markets on the institutional side. So balance your portfolio accordingly. We don't want to be just in single positions and say, oh, I'm going to trade to the downside or I'm going to trade to upside. We want to have a balanced approach with a leaning towards whatever your bias is. Okay, so good luck trading today. We are about 10 minutes away from the open. So I will leave you to prepare for the opening and see you in the aftermarkets.